Hello everyone, welcome to this session on monetary policy formulation and structure. And here we will explore how central banks shape macroeconomic environment and in turn influence business decisions. So monetary policy is one of the most powerful tools for stabilizing an economy. It governs the supply of money and credit and influences interest rates, ultimately impacts economic growth, inflation and employment. For businesses, understanding how monetary policy is designed and implemented is critical because it affects borrowing costs, investment planning, consumer demand, and exchange rate risk. In today's lecture, we will focus on the structure and formulation of monetary policies, drawing insights from both India and the United States. This comparative perspective will help us to appreciate one, the institutional framework, how the Reserve Bank of India and the Federal Reserve systems in the US are structured to formulate the monetary policy. And second one, the decision-making process, the role of monetary policy committees and open market operation committees on an inflation targeting framework and policy communication. So by the end of this session, you will understand not only how central banks in India and the US formulate monetary policy, but also why these policies are vital for business strategy and economic decision making. So let's begin by examining what are the implications of understanding the institutional structures of monetary policy on businesses and markets. So to begin with the implications, so the important thing is that when an expansionary monetary policy takes place, you know that there is more money in the economy and the rate of interest will decline. But at the same time, you can see that there will be inflationary risk. On the other hand, if there is a contractionary monetary policy, that means the money supply in the economy declines, it reduces, then there will be increase in the rate of interest. At the same time, there will be low level of inflation. Right. So always there is a trade-off. One, if there is a decline in rate of interest, then there will be increase in inflation because of the changes in money supply. Right. So that is the trade-off between that. Keeping that point, that in mind, what we can see that it has implications for the businesses. So the first and foremost one is that the credit availability. So for example, a rate cut, what I mean by rate cut means an expansionary monetary policy. So if there is a rate cut, even interest rate cut, for instance, so there will be cheaper loans will be available to the businesses. That means the capital, they get a capital finance they get at a cheaper cost. The rate of interest is very low, so there will be more financial transaction, there will be more credit flow, that the credit channel that will get strengthened, the financial flow will get strengthened with the companies. On the other hand, you know that if the rate of interest increases, and that means the cost of borrowing for the firms increases, that means the cost of production increases, so that means because of there is restricted credit. And the second one is market liquidity. So imagine a expansionary monetary policy, you know that injects liquidity via open market operation or a decline in the repo rate. So that means with the banking system, there will be more liquidity, more money available, and as a result, there will be more money with the general public also. So for a business, what the implication is that it's not only for themselves. First of all, if the liquidity increases, they get cheap credit. At the same time, if the liquidity with the bank banking system and the general public increases, that means there is more money, more purchasing power with the general public. So the companies can foresee that these operations are going to give it increase the aggregate demand. There will be more demand for goods and services from the general public. So in contrast, you can see contractionary monetary policy. Suppose the central bank is following a contractionary monetary policy, then means accordingly the businesses need to get prepared. That means they know that the aggregate demand is going to decline, so they need to strategize their investment in the expansion of production facilities. They need to strategically manage. Then for us overall, for the business planning, I would list out these other aspects. One, in investment decision is help because sensitive to borrowing cost and credit conditions, and similarly pricing and production strategy. Suppose if there is increase in money supply, then you know the rate of interest will decline, but at the same time there is a high probability for, there is a likelihood of increase in the rate of inflation. So that means when there is an inflation, then accordingly the value for money is declining, then accordingly the pricing strategy of the firm also need to adjust as per this at par with the expected rate of inflation. So that has implication not only on the prices of the goods and services, the final output, but also on the input cost as well. So then the other aspects is that the risk management, because there will be currency, the forex rate volatility, similarly interest rate volatility, all these affect the hedging strategies in the finance market. So similarly the expansion plans, it depend on the long-term credit and stable monetary conditions. So in short, about the last point what I meant here is that about the firms, if they have to what extent they need to expand their production capacity. So that all depends upon the availability of long-term credit, and as well as similarly the rate, the stability in key economic parameters including inflation, rate of interest and foreign exchange rate. So it all depends on if the monetary conditions and the monetary policies are stable. So I just summarize all these points in using a table. So I just see policy stance, either expansionary, neutral or contractionary. So what are the implications of this one on credit and liquidity, and what are the business responses? So for instance, if there is an expansionary monetary policy, that means they are going to get easy loans, the cost of borrowing declines and there will be high liquidity. So in this case, the business firms, they can expand their size of their operations, and that means through higher investment and hiring, because they can see that the cost of production has declined, and at the same time the market, there is more liquidity, there is increase in aggregate demand. So these are the key insights here. Monetary policy directly shapes credit conditions and market liquidity. So the business strategies, the firms, they must adapt to the policy shifts. So in this case, the firms need to monitor central bank signals, because that is essential for a proper and robust financial planning for the firms. So let's now move to understand how monetary policies are structured and formulated in India. And you know already that RBI, the Reserve Bank of India, is the central bank of India. So let's have a quick overview of the historical aspects. RBI was established in 1935, and you know that is headquartered in Mumbai, and its central board governed by RBI governor appointed by the central government. And you also know that there are several regional offices for RBI. In total, there are 22 regional offices across India. And the functions of the RBI, one is issue of currency, except 1 rupee note and coin of smaller denomination, which are issued by the government. The rest of the major currencies are issued by RBI, Reserve Bank of India. This act acts as a banker to the government, to both central and state government. So it carries out all banking businesses of the government for all the departments, ministries and departments of the government. All their cash transactions are mostly done to the central bank. So similarly, central bank accepts, receives and make payment on behalf of governments. So furthermore, central bank gives loans and advances to governments for temporary periods. And another important function of Reserve Bank of India is the exchange rate control. So RBI takes steps to ensure external value of a rupee using exchange rate control system. RBI follow a managed floating system. That means to some extent it allows the flexible exchange rate system, but in case if the rupee is under threat, then RBI intervene in the market with its forex reserve. Then the fourth one, it acts as the banker's bank, is the apex bank of the country, and acts as the banker's bank and supervisor. So regulator and supervisor of the financial system, mostly of the banking system. So prescribes broad parameters of banking operations within which the country's banking and financial system functions. So the more important, the why central bank is doing this, because the financial market, that is the backbone of any economy, because that enables channelizing the funds where it is surplus funds to most productive users. So that means this helps in channelizing funds from the households to the firms especially. In this context, most of the general public money, they instead of directly getting involved in the finance market, for instance secondary market, most people they prefer to put their money, deposit their money with the banking system. So in this case, and it is the objective, the goal of the Reserve Bank of India to ensure maintain the public confidence in the system, protect depositors' interest, and provide cost-effective banking services to the people. And here, while doing that, while acting as a banker's bank and supervisor, is the custodian of the bank's cash reserve. Yeah, you already know that the cash reserve ratio, that is the recurve reserve ratio of the total demand and time deposit, a certain fraction has to be kept with the central bank as the reserve. And second one is act as the lender of the last resort. In case a bank is in a deep financial struggle, financial crisis, at that time central bank would act as the lender of the last resort, and also acts as a bank of central clearance, settlement and transfers. For example, you are making a financial transaction to another person through your bank, and that person has the account in the another bank, not in your bank. At this time, it is the central bank, it acts as the clearance house and make all the settlements and transfers easier. Okay, so coming to now RBI, the RBI is one of the main function of RBI is that it formulates and implements monetary policy. So in that way, it is the monetary authority of the country. So it acts as the controller of credit and money supply. So in the one of the previous session, we have discussed how central bank, by using the monetary policy tools, how it influences liquidity with the banking system. For example, we have seen using open market operations and discount loans. We have seen it generates reserve with the banking system, through which it finally affects the money supply. So it formulates and implements monetary policy. That means maintaining price stability and ensuring adequate flow of credit to productive sectors. So this a quick overview, this we have discussed in one of the previous section. What are the monetary aggregates, how money supply is being defined in India. So mainly you can see M3 money, that is the broad money supply, that is the money supply definition that RBI follows in Indian context, that is M1 plus time deposits with the banking system. So we have already seen several monetary policy instruments. So let us have a quick overview of these. Some of them we already discussed, and a few I will list here. One is there are several direct and indirect instruments that are used for implementing monetary policy by the RBI. One is the most prominent, it's called the repo rate. That is the interest rate at which RBI provides liquidity under the liquidity adjustment facility against the collateral government and other approved securities. And reverse repo rate is the interest rate at which RBI absorbs liquidity from banks against the collateral of eligible government securities under the LAF. And the cash reserve ratio, we have already defined it. Then coming to statutory liquidity ratio, in one of the session I have clearly defined it, that in addition to required cash reserve ratio, banks need to keep SLR as well. It comes approximately 19% of the total deposits. Then open market operation, we thoroughly discuss it. Then bank rate, that is the long term lending rate at which central bank lend to the commercial bank at long term. And these are some more related terms. One is standing deposit facility rate. I would suggest you visit RBI website. There is a detailed description of what does this facility means and how does it work. And similarly about marginal standing facility also, you please go through the RBI website and you will get more details about it. These are a little bit indirect instruments being used by RBI. Let's now move to the Monetary Policy Committee. Who implement monetary policy in India? So it's RBI, but within RBI who? Is by the Monetary Policy Committee. So the section, this one, that the RBI Act provides the constitution of a 6-member Monetary Policy Committee to determine the policy rate required to achieve the inflation target. So the first empowered 6-member committee, MPC, Monetary Policy Committee, was set up in 2016. So the members include, I have already listed here, MPC is required to meet at least 4 times in a year. So each member of the MPC has 1 vote. In the event of an equality of votes, governor has a second casting vote. So importantly, each member of the MPC writes a statement specifying the reason for voting in favor of or against the proposed resolution. So in RBI website, you will get the statement by each of the MPC member after each monetary policy announcement. So in 2016, we amended to provide a statutory basis for the implementation of the flexible inflation targeting. So central government, in consultation with the RBI, determines the inflation targets in terms of consumer price index once in every 5 years. So in August 2016, we announced the inflation target is 4% plus or minus, that is the upper and lower tolerance limit. That means max is 6% and minimum is 2%. So the mandate here is, the mandate for the RBI is to retain the inflation and between 2% and 6%. And in 2021, we retain the same inflation target. So in case the RBI fails to maintain the inflation target, central government has notified some of the factors that constitute failure to achieve the inflation target. The average inflation is more than the upper tolerance level of the inflation target for any 3 consecutive quarters, then central government decided that note that RBI couldn't meet the inflation target. Then similarly, the average inflation is less than the lower tolerance level for any 3 consecutive quarters. So the monetary policy process, I have detailed text here, so you please go through this. So how they meet and how they make decision, and finally there will be the MPC resolution. So here our bank publishes, after the conclusion of every meeting of the MPC, the resolution adopted by the said committee. Then the RBI governor also give a media brief about it. So these are the key rates. You please click this link from the RBI website and you will get key rates that are being followed. I'm also giving some of the repo rate, some text here related. You can just go through this. So also I'm just just to give a flavor, I'm just showing some rates and ratios, including bank rate, policy repo rate, reverse repo rate, SLR, CRR, etc. So having discussed this, let's now move to how the monetary policies are structured and formulated in the US. That is one of the first largest economy in the world. So let us see how they formulate the monetary policy. So in the US, there is not one central bank, there is central banking system, but they set up the Reserve Central Bank at a later point. but much earlier than India. So because the reason that there was a resistance of establishment of a central bank because of fear of a centralized power, putting everything on one agency. So there was a distress of moneyed interest among the general public, banking system and other stakeholders. So however, the nationwide panic on a regular basis had been happening. So there was no lender of last resort for the banking system. So for instance, the panic of 1907 so severe that public was convinced a central bank was needed. So accordingly, the Federal Reserve Act of 1913 came into existence. So it came with a elaborate system of checks and balances, and the key spirit was that it should be a decentralized central bank, not a heavily centralized one. So keeping this in mind, the writers of the Fed Reserve Act wanted to diffuse power along regional lines between the private sector and the government and among bankers, business people and the public. So accordingly, initial diffusion of power has resulted in the following way. There will be a board of governors of the Federal Reserve System, and instead of one central bank, there will be Federal Reserve Bank. There are 12 Federal Reserve Banks in the US, and the main monetary policy authority is the Federal Open Market Committee. Just like in India, there is Monetary Policy Committee, and in the US is the Federal Open Market Committee. So you can see from this map where Fed is located. You can see that it's located spread all the 12 regional Fed banks. It's located across the counties. So you can see here is the Federal Reserve System. Board of Governors are located here. And this is briefly about the structure and responsibilities for policy tools in the Federal Reserve System. So these are the Federal Reserve System, how is structured. You can see on the top part, you can see 12 Federal Reserve Banks. They elect 6 directors to each FRB. So there are more than 2000 member commercial banks, and there are also members from the general public as well. You can see 12 members, bankers. There is Federal Advisory Committee, and the policy tools of this, they have reserve requirement, discount rate, but the open market operation, this is the main tool, and this is mainly directed by the Open Market Committee. They direct the open market operation to influence the liquidity with the banking system. So in short, Federal Reserve Banks are quasi public institution owned by private commercial banks in the district that are members of the Fed system. There are Class A directors to represent professional bankers, Class B directors. It also have representation from general public, prominent leaders from industry, labor, agriculture and consumer sector. There are Class C directors appointed by the Board of Governors to represent the general public. So member banks, I already mentioned, all national banks are required to be the members of the Federal Reserve System. So the functions of Federal Reserve Banks, I have listed these. I have taken all these from the FRB, Federal Reserve System's website. The directors establish the discount rate, and 5 of the 12 bank presidents have a vote in the Federal Open Market Operation Committee. So they meet 8 times. The FOMC meets 8 times a year, and you know that it has implication globally. You know that the stock indices across the globe fluctuate. It moves according to the meeting of the FOMC. So sometime if they raise the and if they lower the rate, it has implication in the stock market and debt market. So this is about the policy tools. These are all already listed in their website. You please follow this link. The main tool the FOMC use to control the money supply in the economy, the liquidity in the economy, is the Fed fund rate. Fed fund rate is a short-term overnight rate that the interest rate banks charge each other to lend Federal Reserve funds overnight. So that means Fed fund rate is not actually the rate at which the central bank gives loan. Instead, it is the loan rate at which one bank borrows from another bank. That means that one bank lends and another bank borrows in order to meet their Federal Reserve requirement. So these are short-term interest rate. So bank also, it has implication for the other interest rate, because banks also base the prime rate on the Fed fund rate. For instance, bank charge their best customers the prime rate just 3% above the FFR. So longer term interest rates are indirectly influenced, because you please refer here the term and risk structure of interest rate, you know how short term and long term interest rates are related. And you also see that if prime customer, the one rate of interest based on the one instrument are related to another based on the risk structure as well. So the important thing is that why Fed fund rate? The reason is that the large commercial banks, they need to keep 10% of their total deposit with the central bank, and small banks, they need to keep 3%, and those banks who have a deposit less than 16.3 million, they don't need to keep any reserve. So in this case, some banks always have that they will face a deficit, shortage in meeting the reserve requirement, then they will borrow from other bank, those who have surplus fund. So important thing to remember, this FFR is not the rate. The central bank or the federal FOMC cannot directly determine, fix the FFR. They cannot say one bank that this is the rate at which you should lend, and it cannot also, it cannot say another bank that it is the rate at which you should borrow. So what Fed does here is entirely different. Using the monetary policy tools, it influences the Fed fund rate, the rate at which the banks transact each other. It using the Fed fund monetary policy tools, it influences. It cannot determine Fed fund rate. That is, if someone say that Fed determines the decides on the Fed fund rate, that is a wrong statement. It can only influence using the tools. And here, unlike India, the US banks, they get interest rate for the reserve that they are keeping with the central bank. So for example, if they keep, this is at one date, for example, in this particular date, if what are the required reserve as well as the excess reserve, they get interest income from central bank. So this is actually for the required reserve, and also on the excess reserve, they get interest income from the central bank. But in India, you remember, until now, there is no, central bank doesn't give interest income to commercial banks for the reserve that they are keeping. And discount policy, I also discussed this one already. So this is called primary credit rate. That means the member banks can get loans from the US central bank, Federal Reserve banks. And this is just to give the different interest rate at a different point of time. So you can just see the primary credit rate, secondary credit rate, etc. So what I have shown here is that two things. One, the member banks, they get interest income for the money, reserve, be it required reserve or excess reserve that they are keeping with the central bank. That is one. Second one, each and every member bank, they are entitled to get discount loans from the Federal Reserve System. Using these two tools, the Federal Reserve System influence the Fed fund rate. So here also there are some terminologies are there. One is Fed fund rate. Fed fund rate is the interbank loan rates, the actual rate at which the one bank transact with another bank. So there is no common Fed fund rate. Maybe bank A and bank B, they may be having one rate, and then transaction between bank C and bank D, maybe a slight difference may be there, maybe 0.5 or 0.01 or 0.4, something like that. Slight difference will be there, because the transaction between one bank and another is purely between that banks. Nobody can outside cannot say that at this rate you need to lend. But there will be slight difference, but the central bank can influence that rate. So then comes the target Fed fund rate. This is set by the FOMC. They wish to have, they target, this is the expected, this should be the Fed fund rate. And in order to attain that, the central bank, the FOMC, use its monetary policy tools. Then the effective Fed fund rate, that is the mean value of observed Fed fund rate. Suppose there are 2000 banks, they are transacting each other. Then you can see one-to-one only transaction is there. Then there are, you can see so many actual Fed fund rate. Maybe the variation may be very less, maybe 0.001. But what we get is that the effective Fed fund rate, what we see in the media, in the website, is the mean value of the observed Fed fund rate. and they influence, the central bank influence the upper bound and lower bound of the Fed fund rate. One using the lower bound, they say that this is the lower bound of the FFR, that is based on the interest rate on reserve, because Fed fund rate will never go below the interest rate on reserve, because no one will lend to another bank below the interest rate on reserve, because instead of lending to FFR, to the Fed fund market, it is better to put the money with the central bank. They will get the interest rate on reserve. So because of that, the lower bound of the FFR will be always the interest rate on reserve, and it will never go the upper bound of the FFR. It is determined by the discount rate. FFR will never go above the discount rate, because borrowing from the Fed is a substitute. Suppose if the Fed fund rate is above the discount rate, then no one will borrow from Fed fund market. They can directly borrow from the central bank. So that means the lower bound and the upper bound is influenced by the central bank by using interest rate on reserve and discount rate respectively. So the relative advantage of different monetary policy tool is that here open market operation is the dominant policy tool of the Fed, since it has complete control over the volume of transaction. These operations are flexible and precise, but the discount rate is less well used because it is no longer binding for most banks and can cause liquidity problem. So what we have covered here is that mainly in our this session we covered how monetary policies are structured and formulated, mainly by drawing insight from US and Indian example. In the next session we will continue this discussion, but morely about the what are the monetary policy strategies and tactics. And thank you for watching this session. Thank you.